Welcome to this special Thanksgiving Day episode of the Balancing Act podcast. As we gather with family and friends this week, I've been reflecting on gratitude, not just for the people in our lives, but for the knowledge and skills that empower us to build better futures. Financial literacy is one of those foundational gifts that we can give ourselves, and that's why I'm excited to introduce you to my other show, Money Lessons with me, Andrew Temte. Money Lessons shares the same mission as the Balancing Act, supporting your journey of continuous improvement and lifelong learning. But instead of leadership conversations, Money Lessons transforms complex economic concepts into accessible, engaging stories. Each bite-sized episode builds your financial knowledge through historical narratives that connect directly to your personal financial decisions today. Whether you're navigating your career, building wealth, or planning for retirement, understanding how money and the economy works is essential to your success. And on this Thanksgiving, I'm grateful for your commitment to growth, both as leaders and as informed financial decision makers. So, my gift to you this holiday is last week's episode of Money Lessons. Happy Thanksgiving to you and yours. Good morning, everyone. I'm excited to announce that we're rebranding the Saturday Morning Muse to Money Lessons with me, Andrew Temte. The new name better reflects our shift from general weekend musings to a focused financial literacy series. If you're new to the show and want to follow the complete journey from the foundations of trade and money through modern markets, start with our episodes from January of 2025 and work forward. Thank you so much for being a part of this journey. Now, let's get to today's lesson. Today is November the 22nd, 2025. Last week, we explored how the 1929 stock market crash led to sweeping regulatory reforms, the Securities Acts of 1933 and 1934, the creation of the Securities and Exchange Commission, and Glass-Steagall's separation of commercial and investment banking. These reforms established disclosure requirements, prohibited market manipulation, and created investor protections that remain foundational today. But regulation alone didn't solve a fundamental problem. How could someone with modest savings achieve diversification? Remember from our insurance series how spreading risk across many participants makes individual losses manageable? Well, the same principle applies to investing. Owning many different stocks reduces the impact of any single company's failure or economic challenges. But building a diversified portfolio required substantial capital and expertise that most Americans lacked. Today, we're exploring how mutual funds solved this problem and enabled millions of ordinary Americans to participate in equity markets. So, picture yourself as a middle-class investor in 1940 with $1,000 saved, a substantial sum at the time. You want to invest in stocks, but you face several obstacles. First, broker commissions were high, often several dollars per trade. Building a diversified portfolio of 20 or 30 different stocks meant substantial costs that were eating into the principal of your investment. Research was difficult without the internet or readily available company information, and evaluating businesses required time and expertise that most people didn't have. The result? Most Americans either avoided stocks entirely or took concentrated risks by buying just a few stocks, exactly the opposite of what diversification would tell us to do. So, the concept of pooling investors' money was not new. Investment trusts had existed since the 1800s, and we saw how problematic some became during the 1920s speculation boom that we talked about last week. But the Investment Company Act of 1940 created a regulatory framework that transformed these investment pools. The Act established strict rules. Fund managers had to register with the Securities and Exchange Commission. They had to provide detailed disclosures about strategies and fees. They had to maintain independent boards protecting shareholder interests, and they had to calculate share prices daily based on actual security values. Most importantly, mutual funds offered continuous redemption. You could sell your shares any time at that day's calculated price. This liquidity made mutual funds far more accessible than earlier investment trusts. Here's how it worked. When you invested $1,000 in a mutual fund, your money pooled with thousands of other shareholders. The fund used this combined capital to build a diversified portfolio, perhaps 50 or 100 different stocks. You owned a proportional share of that entire portfolio. So if the fund had held $10 million in assets and you invested $1,000, you owned 0.01% of every stock in the portfolio. Your $1,000 gave you instant diversification that would have required far more capital to achieve alone. Mutual funds grew steadily in the post-war period. By 1950, fewer than 1 million Americans owned mutual fund shares. By the early 1970s, assets had grown to tens of billions of dollars with millions of shareholder accounts. The mutual fund had successfully brought stock market participation to the middle class. Now, in 1976, a revolutionary development occurred. Jack Bogle, founder of the Vanguard Group, launched the first index investment trust, the world's first index mutual fund available to individual investors. Bogle's insight was profound and, to many, heretical. Rather than paying managers to actively pick stocks for you, investors could simply own all stocks in a market index like the S&P 500. This passive approach offered several advantages. Costs were dramatically lower. Index funds charged a fraction of what actively managed funds demanded, with fees that have continued dropping over time. Index funds were more tax efficient, trading rarely and deferring their capital gains. And most surprisingly, index funds often outperformed actively managed funds. After fees and taxes, most professional managers failed to beat the market over long time periods. The investment industry initially mocked Bogle's creation, calling it un-American to settle for average returns. But decades of research proved Bogle right. S&P Dow Jones Indices, the organization that maintains major market indices like the S&P 500, has tracked thousands of actively managed funds against their benchmarks since 2003. This is also called the SPIVA reports, S-P-I-V-A. There won't be a quiz on that. The results are striking. Approximately 85% of large cap actively managed funds fail to beat the S&P 500 over 10-year periods, and nearly 90% outperform over 15-year periods. While costs certainly matter, academic research by Nobel laureate Eugene Fama and others suggests the core challenge is that in competitive markets with widely available information, consistently outperforming becomes extraordinarily difficult, even for skilled professionals. So, passive management outperforms active management in many cases. Remember our compound interest series where investing $5 daily could grow to nearly $1 million over 40 years at the rate of return of the broad stock market? Well, that calculation assumed earning the stock market's historical 10% average return. Index funds made that assumption realistic. Before index funds, achieving broad market returns required either substantial wealth to build your own portfolio to mimic the S&P 500 or the Dow Jones Industrial Average, or accepting high fees and potential underperformance. Now, someone investing $5 daily could buy fractional shares of a fund owning 500 companies at minimal cost with no expertise required. The power of compound interest had become accessible to everyone. Today, trillions of dollars are invested in index funds. Mutual funds, both actively managed and indexed, enable genuine democratization of equity investing. A teacher, nurse, or factory worker could now build the same diversified stock portfolio that previously required substantial wealth. We've only scratched the surface of diversification and mutual fund investing today. In future episodes, we'll explore how to build properly diversified portfolios, understand different types of mutual funds and exchange-traded funds, or ETFs, evaluate fund performance, and navigate the practical decisions that every investor faces. This democratization through mutual funds set the stage for the next revolution: electronic trading systems and zero-commission brokers that would make investing even more accessible. Next week, we'll explore how technology transformed markets from crowded trading floors to smartphone apps, completing the journey from exclusive clubs for the wealthy being able to invest in equities to truly accessible markets for everyone. So, until next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is Money Lessons. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public good with your friends, your neighbors, your colleagues, and maybe a family member if you like them. The show is produced by Nick Temte. We'll see you next time on Money Lessons with Andrew Temte.